Hello and welcome. Now, if you've ever dealt with the sale of a capital asset, you know that valuation is absolutely everything. In this explainer, we're going to break down Section 91 of the new Income Tax Act 2025. It's a provision that really gets to the heart of how your capital gains are calculated and, ultimately, taxed. So, picture this. You've just closed a big transaction. Maybe you sold a piece of land or perhaps some unlisted shares. You've done all your homework, calculated the gains, and filed your returns. But then you get a notice. The tax department has a question. Is the value you've declared the real market value? And this right here is such a common friction point in tax assessments. The assessing officer, or the AO, takes a look and forms an opinion that the fair market value of your asset is actually much higher than what you've stated. This single difference of opinion can quickly spiral into a major tax dispute. So how does the law step in to handle this? Okay, here's our game plan. We'll start by tackling the valuation puzzle itself. Then, we'll decode Section 91. From there, we'll look at exactly when a valuation officer gets called in, run through a practical case study, cover compliance, and then wrap it all up with the key takeaways. All right, first up, the valuation puzzle. Trying to pin down the exact value of a capital asset, especially something that isn't traded on the stock market every day, it's often more of an art than a pure science. And this subjectivity, well, that's where the disagreements usually start. See, your entire capital gains tax calculation really hinges on this one number, the fair market value. As a taxpayer, of course, you want a valuation that's fair and accurate. But the tax department, their job is to make sure assets aren't being undervalued to reduce the tax bill. This natural tension is exactly what Section 91 is designed to manage. And that brings us right to the heart of it, Section 91 of the Income Tax Act 2025. This is the specific legal tool the assessing officer uses to try and resolve these tricky valuation disputes. So what does this actually mean in plain English? Well, think of Section 91 as the AO's power to get a second expert opinion. If they have any doubt about the value you've declared, they can refer the matter to a specialist inside the department, the Valuation Officer, or VO, whose whole job is to figure out the fair market value. Now, a really important point here is that Section 91 isn't some brand new idea. It's basically the next chapter for what used to be Section 55A in the old 1961 Act. The core principle hasn't changed, which is great because it provides continuity and means all that existing case law is still very relevant for us tax pros. So how does the AO actually kick this off? The law basically gives them two main pathways. First is if they just don't agree with the valuation report you submitted, even if it's from a registered valuer. And the second pathway is if their own estimate of the value is higher than yours by a specific amount, or if the asset is just so unique or complex that they need an expert to weigh in. Okay, so that begs the question, right? What are these prescribed limits? The AO doesn't just have unlimited power to do this. The law is very specific about the financial triggers that have to be met. Let's take a look at what they are. The first number you absolutely need to remember is this one, 15%. This is the percentage threshold. And the second key figure is 10 lakh rupees. This is the absolute value threshold. So the question is, how do these two work together? Well, Rule 55 of the Income Tax Rules 2026 lays it out very clearly. An AO can make a reference to the valuation officer if their estimate of the fair market value is higher than your declared value by either more than 15% of your value or by more than 10 lakh rupees. And remember, the key word there is or. Only one of those conditions has to be met. But hold on, it's not just about the numbers. The AO also has some discretionary powers. As we just saw, they can make a reference if they simply don't agree with the report from your registered valuer, or if the asset itself is just plain tricky, like a piece of art or a complex financial instrument, they have the flexibility to refer it. All right, theory's great, but let's make this really practical. A case study is the best way to see how these rules actually apply in the real world. So let's take an example. A taxpayer sells some unlisted shares and declares their value at 60 lakh rupees. The assessing officer does their own digging and believes the fair value is more like 70 lakh. Now, the absolute difference here is exactly 10 lakh rupees. But here's the kicker. Look at the percentage difference. It's 16.67%, which is over that 15% threshold. Because it crossed that percentage trigger, the AO has every right to refer this to the valuation officer. So, knowing the AO has these powers,
How can you or your clients actually prepare for this kind of scrutiny? Let's talk about some practical safeguards.
Look, the best defense is always a good offense. First, have robust documentation for everything that backs up your valuation. Second, don't just get any old report. Get a detailed, credible valuation from a qualified, registered valuer. You need to be ready to explain and defend the methodology you used. And finally, always remember that the VO's report is going to carry a lot of weight with the AO in the final assessment.
And on the flip side, here are some common traps to avoid. Just stating a value with no backup is a huge red flag. Same goes for using old, irrelevant data. And another thing, poorly drafted sale agreements that are vague about what's being sold and for how much. That's just inviting scrutiny.
Okay, we've covered a fair bit of ground. Let's quickly boil it all down and summarize the key takeaways you really need to remember about Section 91. So, let's recap the checklist. Number 1, Section 91 is the AO's go-to statutory tool for challenging valuation. 2, remember the magic triggers, a difference of more than 15% or 10 lakh rupees. 3, the AO has discretionary power beyond the numbers. And that brings us to the bottom line. Be prepared. A solid, well-documented report from a reputable, registered valuer is your absolute best safeguard.
And that concludes our deep dive into Section 91. I really hope this explainer has been helpful. Thank you so much for joining us. If you found this valuable, please go ahead and like, subscribe, and share it with your colleagues.
This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.